Hey traders, this is Blake Morrow with Trader Summit, and it happens to be Friday, and I have Mr. Jim Welsh from Macro Tides. He's here, and Jim, I gotta say, and let me bring you in. I'm sorry, I didn't. There we go. I brought you in here. I have to say,
Good.
you said the dollar's going down, but you didn't say it was going to be a dumpster fire sale. I mean, come on, the dollar's just getting smashed here. What's up with that?
Well, the thought has been that the dollar could have a bounce before it dropped to the mid 90s, below 95. And the key level was, I think it was 100.61 or something. It's on the chart. I'll be able to read it. Because my assumption has been is that the dollar was in a triangle.
Yeah.
A, B, C, D would be finishing now. A wave E would take it towards 104, and then we drop below 95. So that level of 100.61, which was the low of wave B, it is the make or break level for the triangle. And we talked about that last week. And so if you take that out, that opens the door for a direct decline, or much sooner decline below 95. The triangle's still alive as long as you hold above that wave B low. It implies a rally to 104 for wave E, and then you get the dump.
Okay,
so we're at a critical juncture.
Well, we are, and we're going to talk more about the technicals, and have the charts in front of us is going to be
a lot easier. I'm sorry about that.
It is. I know you get so excited talking about things, and I gotta say, hey Jim, hold on. We're almost getting there. We're getting there. But it is really today Powell's speech. I mean, really confirms we're going to get a cut. Just the question, I guess, is, and this is my takeaway, is we really have to watch the data. Especially the jobs report this next in about 2 weeks, because that's going to determine whether it's going to be a 50 or a 25. Did you pull the same thing?
Yeah, I mean, again, I think their bias is to stick with 25. When they met in July, you had a small number, probably 3 people who were in favor of cutting then. The majority wanted to wait and be patient. So I think that was the consensus, where it's like, okay, we're willing to go in September, not quite so soon in July. And I think their bias is for a 25 basis point cut. If the jobs number comes in much weaker than expected, and what we have seen, that will raise the odds from 25 to 50. The key point that I think people have, well, we're going to get into that in a little bit with charts and stuff. I'd rather not jump the gun. So to speak.
Let's do it. Well,
I'm already jumping the gun once.
Since you brought all these charts, Jim, let's start with the first one, and you're gonna have to do a little explaining here.
Explaining, as they say. Okay,
and so mansplain us. What are we
explaining? All right, one of the things that I've been writing about in Macro Tides is, and honestly, I am frightened by what I see happening from a political standpoint in our country. And so I'm going to tick off probably everybody, because I'm going to point a finger both to the left and the right. And I'm going to read something which I included in the August Macro Tides. And I think it's really worth people, no matter what your political bias may be, is to try to be objective and think about the power of this statement. This constant lying is not aimed at making people believe a lie, but at ensuring that no one believes anything anymore. A people that can no longer distinguish between truth and lies cannot distinguish between right and wrong. And such a people, deprived of the power to think and judge, is, without knowing and willing it, completely subjected to the rule of lies. With such a people, you can do whatever you want. So when I look at the landscape, I see lying by both sides. Trump this week said, I'll drop oil prices by 50%. And he tossed in for good measure that he's better looking than Kamala. Okay. I want to go back to, this is one of the themes that President Biden has sounded for the last several years, and numerous Democrats have pounded the table that when we got into office, the economy was in terrible shape. It was in the tank. It was awful, right? Well, let's look back and see exactly how bad the economy was. In the fourth quarter of 2020, GDP was up 4.2%. President Biden took office in January of 2021. And in the first quarter of 2021, GDP was up 5.2%. So the whole narrative that the economy was so weak, we needed then to pass more than $3 trillion worth of spending to pull it out of that tank is completely unjustified. And it goes a little bit further, Blake, in terms of, oh, the inflation that you're experiencing is not because of any spending we did, it was because of greedy corporations and the idea we're going to have price controls on food. And the thing, I did a tweet earlier this week, is if you look at the profit margins of grocery stores, it's less than 2%. You compare that to Microsoft at 35%, Apple at 26%, and GM at 6.2%. So the idea that inflation was caused by price gouging is a lie. It's not a truth. And it was founded, though, on the idea that the economy was in such horrible shape, we needed to do all this spending. And the reality is facing us right here. All right. And so to me, again, my fear and why I feel frightened is because I see both political parties lying. And now it's a question of who can lie better to get more votes in swing states. It isn't about policy. It isn't about really what they're planning to do for the country. So again, I just would like everybody, whether you lean left or right, to try to be more objective about the lying that's taking place by both candidates, both parties. And what does that mean for our country? So, end of
rant.
Talk.
Okay.
Yes.
Well,
yes.
let's talk about today. And we're filming on Friday, August 23rd, shortly after Powell's speech. What are you looking at here?
Well, this is just very simply is going back to 2000 and looking at, okay, in the week after a Jackson Hole speech, what has the S&P done? And what we can see is in 16 out of 24 years, the S&P has moved by more than 1%, sometimes to the downside, a little bit more frequently to the upside. And obviously, we've already done that today. The S&P was up over 1%.
Right.
So the point is that there's always, or consistently, there's a lot of expectation going into Jackson Hole, and what the Fed governor or chairman says matters. So that's all. Just a little historical perspective.
Okay. Well, thanks for bringing that up. So moving right along, the next one you want to talk about the huge jobs revision. I mean, this was on everybody's radar this week, and what did you make of it?
Well, again, you and I spoke for, over a few months that the establishment survey was exaggerating the number of job creation, especially when you compared it to the household survey and so forth. So what they did is they said, from March of 23 to March of 24, we were off by 818,000. The only time it's been a bigger miss was in 2009, which obviously was a pretty bad year. Now, again, what complicates this? So, some people are like, oh my God, the labor market is really in bad shape. No. Again, we have to keep in mind that the unemployment rate has gone up in part because more people are entering the labor force. And some of those people are not native-born Americans. And so the way the Labor Department calculates these numbers is that potentially, again, the unemployment rate in part has gone up because of this influx of supply. Some of it is under the books, so to speak. And so what that implies is that we can, I think we talked a month or two ago about the data collection process and the participation rate on various surveys that the government takes. And it's gone from 60, 65% in some of these surveys down to 30. Well, that is going to obviously have an impact in terms of the quality of the output. And so again, my point is the economy softening? Yes. Is the Labor market easing, yes. I think this number probably overstates it a little bit. And, as such, I just think you shouldn't overreact it. And I doubt the Fed members will overreact to it.
Okay. All right. Good point. I'm glad you brought that up, but it's still going to be, non-farm payroll is going to be very important in 2 weeks, right?
Oh, absolutely. But again, also things like participation rate, which, most people never pay any attention to, but have been really important over the last 6 months. There's been a nice increase in the participation rate. Well, what is that? That means more people want to get involved in the labor market. And that's happened while the unemployment rate has gone up. So that is contributing and has contributed to the increase in the unemployment rate, which is why I think Powell and other FOMC members have not been hitting, if you will, the panic button. Remember, they projected, I think, 4 or 4.1% on the unemployment rate at the end of this year. Well, last month it was 4.3. But when they look underneath the surface, they can see that, all right, there's extenuating circumstances which suggest that that number is overstating the true level of unemployment. The other thing I'll mention, warn notices, which are basically companies that are going to plan to lay off somebody, Blake, have to give a warn notice. It has to be 60 days in advance. Those are still very low. So what we're seeing is companies have cut back on hiring, which is why job growth has slowed. But we haven't seen the next phase, which is letting people go. And until that happens, the economy is going to continue to kind of chug along. I think it's coming, but we're just not there yet.
All right. Well, tell us what's going on with discretionary spending, because these charts don't look like they're bullish.
We have a bifurcated economy. The bottom 40% of wage earners have burned through their savings. They are having trouble going to the grocery store and so forth, paying rent and so on. At the same time, you have those at the upper end that have been having a great time in terms of traveling. And what this shows is airline travel, cruise lines, accommodations, and there has been a noticeable slowing. So this is just a hint that, wait, maybe some of the people at the top who have the wherewithal to spend are starting to scale back a little bit. It's just one of those, and I would call it anecdotal pieces of evidence that, again, around the edges, things are softening. But obviously, as I noted last week when we talked about the retail sales number, it was up 1%. Yeah, but the reason it was up because car sales added 0.6%. And the reason that happened is because in July, there was a cyber attack on all the dealerships in the United States, and they really couldn't conduct business. So again, we're at an inflection point. One has to dig deeper when you look at these numbers, Blake, because at inflection points, you get, if you will, cross currents. And so this is just one more sign to me that, all right, the upper end may be starting to pull back a little bit.
All right. Well, tell us what that means regarding the markets, because S&P, you'd argued that we could indeed hit all-time highs. This was 2 weeks ago, and we're less than 1% away, maybe.
Yeah, we got within I think 27 points yesterday, and probably 30 points today. No, the pattern, once the S&P got above 53.91, to me, the chart then changed in the sense of, okay, we're not going down for a retest or anything like that. We're going up toward a new all-time high. And, what you can see is from that low at 51.19, to me, that was wave 4 from the low back in April. We're in wave 5. It implies a move. Wave 1 of 5 was about 200 points. If we had 200 points on top of 55.61, you're talking 57.60. Anyway, so to me, yes, I just think that the chart pattern has changed. I thought 2-3 weeks ago when people were like, "Oh my God, the unemployment rate went up a lot," and that was a total misinterpretation of just how weak. Like, "Oh my God, the Psalm rule says we're in a recession." My take was, no, that's not the reality. And I think as the data has come in to kind of comfort people, this is why we've seen a pretty dramatic reaction. So I think we're going to get to a new high, high probability, given that we're so close. But thank you for noting that, we talked about this a couple of weeks ago. Now, once we finish this move up, Blake, potentially that will mark an intermediate high, because it'll be 5 up, and we'll see.
Well, you got to sucker. You got to sucker.
Ensues will tell us a lot.
The last amount of people in, right?
Yeah, and what's interesting to me is a lot of the charts of various markets are at a decision point. It's like, okay, we're coming to the fork of the road. Which way they're going? So the S&P making a new all-time high has the potential of completing the rally that we've seen at least from April and maybe even further back. And when we look at Treasury bonds, they're coming, I think, to a fork in the road, and I think that's the next chart. I think.
Well, the next chart would be the 30-year. Yes, it
wow. Is. What do you know? So what we've talked about is Treasury bond yields dropped below that channel that they've been in after topping in April. They got below that. And so to me, staying below that channel is important. Without getting too crazy here, there is a chance that Treasury bonds are, if the economy doesn't slow soon enough, if you will, then I think the Treasury yields and the chart for the 10-year is pretty much identical. Get back in that channel. That opens the door potentially, Blake, to Treasury yields ticking higher and then tagging or getting darn close to the black channel line. So it doesn't negate the long-term outlook that, okay, I think yields are going down. But what it implies is that we're going to have another one of these upward adjustment in yields. So my take would be is if the 30-year gets below 399, what I've recommended in my letter is that TLT getting above the high it reached a week or two ago, I think it was 99.93. It's time to do some selling. And I would say that if the 30-year, would be the same thing in a sense, gets below that 399.9, time to let up a little bit, because I just think that there's the risk here that we're going to see Treasury yields uptick for a little window of time. Again, people are so certain that the Fed is going to be aggressive. Do you know that the market's been pricing in, and it's probably gone up since yesterday, 100 basis points of cuts before the end of this year? Yeah. There's only 3 meetings. Right. So that means one of the meetings has to include a 50 basis point hike. And then they're looking for, I think, 5 or 6 basis point or 5 cuts next year.
Yep.
I just think that doesn't apply unless the economy is weaker, and we're not there yet. I think it is going to weaken. Okay. So that's where we are in Treasury. We talked a little bit about the dollar index. Here's the chart, as I said, the 100.62. Really important it holds that, because if it takes that out, then the idea of a triangle, that pattern breaks down. And instead, you had from the high in October of 22 in the dollar, it dropped from 114.78 down to 101.05. So it dropped 13 points plus. If it takes out that 100.62, what that says is, you had this big decline, you had a rally to 107.34, and now you're in the process of dropping over 13 points from 107, and that gets you to 93.61. So that, again, we're at a crossroads. If the dollar digs in a teal, it's oversold. Sentiment is obviously quite negative at this point in time. And, and I've talked about this for several months. I thought the dollar would weaken as people realize that the Fed is going to be cutting rates at some point in time. And if we get to the point where the economy slows even more materially, that would be even worse for the dollar. So short term, I thought last week there was still a shot for a rally up towards 104 for wave E, and then we'd get the big dump. So we're at a crossroads in the dollar index.
Well, it's been a hell of a decline the last couple of weeks, but You know, a
Yeah.
lot of people say, "Oh, it's oversold," but remember, you guys can't forget, oversold can be more oversold, overbought can be more
Yep.
overbought. So, you know, I always try to remind people of that because I've seen too many moves in my career that they look overbought, but they continue to look overbought or oversold as price continues. So,
Yeah. Well, just look at the dollar chart, Blake, real quick. You can see where over to the left, 1, 2, 3. You see that low at number 3. Well, the RSI was oversold at the bottom of 3. Okay, you got to bounce. Then it went from 104, it dropped 4 points.
yeah,
So gee, oh, I thought it was oversold. Yeah, but then it dropped, beyond that wave 3 low, which is typical. And that's why the idea of using momentum is very helpful. But that's why I think you need price filter, if you will. And one of the things I've talked about is the 5 versus 13 exponential moving averages, because what you can see is you can get things oversold. And like we saw back in December of last year, I think that is, that 513, if you went in because it was oversold, you got to bounce, and then you can see the quick reversal. The 5 and 13, or the 5 crossing below the 13, would have been a nice signal to say, you know what, I'm a little early. So you can see right now the red is the 5, the green is the 13 moving average. They're not even close to being crossing in a
yeah,
positive sense. So,
right.
okay. Yeah.
So gold is your last chart, and gold has been, frustratingly pegged near its highs, but you would think that with the dollar weakness that gold would have rallied to new highs, but it's stalling.
Well, it did. It got up to 25.29, which obviously was a new high, but it's kind of stalling, as you noted, this red trend line. I'm assuming that the probability is it's going to pop above that line. And does it make it to 2,600? I don't know. Again, markets are at a juncture. If the dollar starts to dig in its heels and the triangle is, if you will, reconfirmed, and we get that bounce towards 104, it's hard to believe that gold isn't going to get hit with some selling. So to me, it's like, okay, we're at that window where gold needs to get going here really quick. And if the dollar digs in, then the gold is going to, I think, be set up for another decent sized pullback if the dollar indeed rallies to 104. Conversely, you take out that triangle low, that we talked about just now on the dollar, that should be a green light for gold to move easily to 2,300. So, again, markets, I think, are at crossroads. And, I have no idea with any degree of certainty how it's going to play out, other than knowing what levels to pay attention to as providing clues in terms of how this whole piece will come together.
All right, Jim. Well, then you're no help this week. Jeez, just kidding.
Well,
Jim,
you know what?
it,
I've heard my wife say that.
Yeah, you've
Bada bing.
you've been a great guide, especially through these summer months. It's been so wild in the markets, and I want to thank you for taking us every day. And if you guys and gals do appreciate these conversations that we have with Jim, make sure you're jumping in the comments below, telling him how much you appreciate him. Give him a thumbs up and subscribe to the channel, and also contact Jim at Macro Tides. What's the email, Jim?
Jim Welsh, macro at Gmail or macrotides.com. The one thing I'll point out real quick here, the markets are more vulnerable, I think, Blake, if we get a healthy jobs report. And I think there's a really decent probability that the unemployment rate will tick down from 4.3 to 4.2. So again, in terms of all the expectations, the Fed's going to be cutting 100 basis points this year. What could really upset that apple cart would be a jobs report that's, back to 150 or whatever, and the unemployment rate ticks down. All of a sudden, can the dollar make 104 in that environment? Yes. Can treasury yields tick up in that environment? Absolutely. So that jobs report has the potential of providing a real curveball for markets, given where psychology is right now.
Well, the good news is we'll have another meeting between now and then. And so, so make sure you catch us here next week on Trader Summit with Jim. And Jim, thank you so much for guiding us each and every day. I do appreciate you, or each and every week, excuse me. And I do appreciate you. I know folks at home do as well.
I appreciate you, Blake. Thank you so much.
All right. You guys have a great one, and we'll talk to you next week, Jim.
You got it.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.